So whenever you step onto like a car lot, there's this immediate, almost painful choice you have to make.
Oh, absolutely. It's the classic dilemma, right?
Right. Because you can walk over to the flashy high-end sports car, the one that's trending everywhere, cost way over the sticker price, and, might depreciate the second you drive it off the lot.
Yeah, or you do the sensible thing.
Exactly. You sigh, you turn around, and you walk over to the dusty, reliable minivan that's cheap. But honestly, it might just sit in your driveway gathering leaves.
Right, it's that eternal struggle between the thrill of the new and, well, the safety of a bargain.
And historically, most investors they just accept this binary choice.
Yeah, they throw their hands up and buy a broad market index fund to avoid making the decision at all. They just buy the whole lot, sports cars, minivans, all of it.
Which is fine, but when it comes to investing your actual life savings, that binary choice is kind of terrifying for you. You either buy high-flying growth stocks and risk overpaying at the absolute top of a bubble, or you buy those quote-unquote cheat value stocks.
Which just end up being stagnant value traps for a decade.
Exactly. So if you want the speed of the sports car combined with the safety of a minivan, well, we've got something really interesting today. We are doing a deep dive into a strategy wrapped inside the iShares MSCI USA Quality GARP ETF.
Ticker symbol JRP.
Right, JRP. And our mission today is to demystify how this purely mathematical algorithm attempts to beat the market by finding high-growth companies at a reasonable price.
We're synthesizing some really great independent quantitative research today from Raven Quant and Koala Gains, plus holdings data from stock analysis and the official methodology documents from MSCI and iShares.
Yeah, so let's just jump right in, because before we crack open the algorithm to see how the engine is built, we really should look at the current market environment that's like driving all this anxiety for investors.
Yeah, we have to start there because the research from Raven Quant highlights this staggering metric that just blew me away.
Oh, I know what you're going to say.
Yeah, over the last 20 years, growth stocks have outperformed value stocks by more than 730%.
Okay, let that sink in for a second for everyone listening. 730%. That is not a slight edge. That is an absolute demolition.
It really is. I mean, if you've been a
Mhm.
pure value investor for the last 2 decades, clinging to legacy telecom or like declining retail stocks just because they look cheap on paper.
You've been left entirely in the dust.
Exactly. But that massive prolonged outperformance has created a highly precarious situation today.
Because everyone just crowded into growth, right?
Right. Capital has flowed so aggressively into growth for so long that those valuations are incredibly stretched. Right now, growth stocks are trading at a 48% premium relative to their own historical average price-to-earnings ratio.
Wow, 48%.
Yeah. And value stocks, on the other hand, are sitting at only a 17% premium.
So going back to our car lot analogy, the sports car is now selling for a massive 50% markup just because everyone on Wall Street wants one. And I mean, I want the raw horsepower and the speed, the growth side of the equation, right? But I absolutely refuse to pay a ridiculous markup just because it's trendy.
Right.
I demand a reliable safety record before I buy.
Which brings us to the core concept of DUMP. It stands for growth at a reasonable price. It's the hybrid solution designed for this specific valuation anxiety.
So it's trying to thread the needle.
Right. It aggressively seeks the upside of expanding companies, so you aren't missing out on the speed. But it applies a strict valuation and quality filter, so you avoid overpaying at the peak of a tech cycle.
Now, growth at a reasonable price sounds fantastic on like a glossy marketing brochure. But to figure out how an index actually executes that without a human fund manager sitting there pulling the levers, we really have to look under the hood.
Yeah, the algorithm is fascinating. The MSCI USA Quality John RP Select Index governs this ETF through a very strict 4-step quantitative methodology.
All right, walk us through it. Step one is the growth screen, right?
Right. Step 1. The algorithm takes the entire universe of U.S. large and mid-cap stocks and brutally cuts it in half. It only keeps the top 50% based on a composite growth score.
And what's actually in that growth score? Is it just looking at stock momentum?
No, not at all. It calculates that score by looking purely at fundamental business metrics, specifically forward and historical earnings per share trends, as well as sales growth.
So it doesn't care if a stock price is rocketing up on like Reddit hype or something.
Exactly. If the actual underlying business isn't expanding its revenue and profits, it does not make it past the front door.
Okay, so we kick out the slowpokes and the stagnant companies, leaving only the fastest growing half of the U.S. market on the table. But standard index funds would just take those remaining companies and weight them by how big their market cap is.
Yeah, they'd just buy the biggest ones. But the MSCI methodology does something completely different here. It weights them using a tilt score.
Right, and looking at the MSCI documents, that tilt score is made of two things, a quality tilt and a value tilt.
Yes. Let's start with quality. The algorithm doesn't just care about revenue. It demands a bulletproof balance sheet. It screens for high return on equity, highly stable earnings, and low debt-to-equity ratios.
That last one seems super important right now. It's actively kicking out companies that are financing their rapid expansion with dangerous levels of borrowing.
Oh, the debt-to-equity filter is crucial. I mean, in a zero-interest rate environment, any company can look like a high-growth superstar by taking on massive amounts of cheap debt to fund operations.
But when interest rates rise,
Those companies collapse. The quality tilt ensures the algorithm only rewards companies generating genuine profit from their core operations, not from leverage.
okay, makes sense. Then comes the value tilt. The methodology looks at forward PE, enterprise value to cash flow, and price to book ratios.
Right.
Forward PE is fairly common, but enterprise value to cash flow or EV/CFO, that's a much sharper tool.
It really is. Because enterprise value looks at the entire price tag in the business, including all of its debt, while cash flow from operations measures the raw, actual cash the business generated.
So a company might have a deceptively low PE ratio because of clever accounting tricks, but EV/CFO tells you if they actually have cash piling up in the bank.
Exactly. It forces the index to reward fast-growing, structurally sound companies that are reasonably priced, while mathematically penalizing the ones loaded with hidden debt or trading at astronomical bubble-level multiples.
I love that. But to make sure this math works fairly across wildly different types of businesses, the algorithm uses something called Windsorized z-scores.
Yeah, that sounds like a lot of quant jargon.
It does. The MSCI document leans heavily on these Windsorized z-scores to weigh the companies, but it's actually pretty simple. A z-score essentially grades everything on a standard curve.
Right, so you can compare apples to oranges.
Exactly. It allows the algorithm to fairly compare, say, the capital expenditures of a massive semiconductor manufacturer against a really lean software as a service company.
And the Windsorizing part.
That simply means clipping off the extreme outliers. It works exactly like Olympic gymnastics scoring.
Oh, dropping the highest and lowest scores.
Yes, you
Okay.
drop the absolute highest score and the absolute lowest score, so one biased judge cannot skew the entire result. The algorithm drops the crazy anomalies at the very top or bottom of the data set, ensuring one weirdly priced stock doesn't break the whole mathematical model.
That's a great way to explain it. But, the stock market is chaotic. Earnings reports drop. Prices swing wildly from day to day. Implementing such strict, standardized mathematical rules requires constant adjustment.
Right, and a setup like this must require massive portfolio churn. Like looking at the data from stock analysis, the turnover for this index is around 73% annually.
Which is high.
Really high. A standard S&P 500 ETF usually has a turnover of under 2% a year. A 73% turnover rate seems like it contradicts the whole philosophy of passive index investing. Like we are constantly buying and selling.
It definitely appears contradictory on the surface, but it serves as a vital self-healing mechanism for the portfolio. The index rebalances every single quarter.
Every 3 months.
Yes. But to prevent trading just for the sake of trading, it uses a 35 to 65% buffer rule.
How does that work?
So if a stock was originally in the top 50% for growth, but it slowly drifts down to, say, the 55th percentile, the algorithm does not instantly sell it. The stock has to drift beyond the 65th percentile to trigger a forced trade.
Ah, okay. So it gives the holdings a little wiggle room. It minimizes unnecessary microscopic churn on borderline stocks.
Exactly. This emotionless quarterly rebalancing is really the engine of the strategy.
Yeah, because every 3 months, it automatically trims your winners that have become too expensive, locking in that profit, and it mercilessly cuts the losers that no longer fit the quality or growth math.
Right. Human managers, they agonize over selling a stock they've fallen in love with, or they hold on to a loser hoping it bounces back. The algorithm just runs the math and executes the trade.
Cold and calculating, I love it. But executing a 73% turnover and running this sophisticated self-healing algorithm 4 times a year, that has to have a price tag. Usually, dynamic factor management costs an arm and a leg.
It does in the mutual fund world.
Yeah.
But this ETF operates with an expense ratio of just 0.15%.
Wow, okay, so for every $10,000 you invest, you are paying exactly $15 a year in management fees.
Yep, just 15 bucks.
Now, comparing that to purely passive mega cap index funds, it is slightly more expensive, right?
Yeah.
SPY, which tracks the S&P 500, charges just 0.09%.
True.
And if you want pure, unadulterated growth, the Schwab U.S. Large Cap Growth ETF, ticker SCHG, charges a microscopic 0.04%. You can also get NASDAQ 100 exposure through QQQM for incredibly cheap.
Right, those are the standard alternatives.
So if I could get pure growth for just 4 basis points with SCHG, paying 15 basis points for a JERC requires some justification. What am I getting for that extra money?
The difference really lies in how those funds handle success. Because SCHG and QQQM are market cap weighted.
Meaning bigger is better.
Right. If a massive tech company doubles in stock price without actually doubling its underlying earnings, its weight in SCHG and QQQM simply goes up. You are forced to buy more of it precisely because it became more expensive.
Oh, that's the trap.
Exactly. With GERB, that extra 11 basis points is actively paying for the valuation tilts. If a stock doubles in price but its earnings stay flat, its value score plummets.
And the algorithm says, nope, we're done here.
Right. GERB will automatically trim that position and redeploy the capital into a growth company trading at a fairer multiple. So you are paying a tiny premium over vanilla index funds to get a sophisticated risk management strategy.
Which would normally cost you around 1% if a human mutual fund manager was doing the exact same thing.
Easily 1%.
So you basically pay the cost of a couple of coffees a year to hire a tireless, highly analytical algorithm to manage your valuation risk.
Pretty much.
Okay, so looking at the stock analysis data from August 2026, we can see what this algorithm is actually buying for us.
Let's get into the holdings.
The fund holds 131 individual positions right now. But because step one is that aggressive growth screen, the portfolio leans heavily into the technology sector. Like about 53.4% of the fund is in tech.
Which scares some people.
Yeah, holding over 50% in a single sector looks like a severe concentration risk. Like if tech has a bad quarter, you take a massive hit.
It does look scary, but that concentration is mitigated by a crucial risk management feature hardwired into the methodology. It's the 5% issuer cap.
Okay, explain that.
No single company can make up more than 5% of the portfolio at the time of the quarterly rebalancing.
Whereas in standard market cap weighted funds.
Right. A single tech giant can balloon to 7, 8, or even 10% of your entire investment just because its stock price went on a run.
Yeah, and because of this 5% cap in GARP, the famous Magnificent Seven stocks that have driven so much of the broader market's returns lately, they only make up about 25% of the GARP fund in total.
Which is very reasonable.
Definitely. The top holdings right now are Microsoft at roughly 5.3%, Apple at 4.6%, followed by names like Micron, NVIDIA, and Broadcom.
Some really strong companies there.
But interestingly, looking through this holdings list, there's a glaring omission. Tesla is not in the fund at all.
Right. And that really proves the strategy works as intended. When the algorithm ran its quarterly numbers, Tesla's valuation and quality metrics simply did not pass the strict tilt score screen. So the fund dropped it entirely.
Just completely booted it.
Yeah. Think of the algorithm as a bouncer at a very exclusive club, strictly enforcing the dress code.
I love that.
It does not matter how famous you are or how much media hype surrounds your CEO. If your fundamental math does not check out this quarter, you do not get in.
The bouncer operates with zero sentimentality. And, the rules are highly logical, the risk management through the 5% cap makes sense, and the holdings look solid.
The theory is sound.
Right. Ultimately, though, you cannot deposit a good theory into your bank account.
Nope.
The scoreboard is what matters. So let's look at the trailing returns from Koala Gains as of mid-2026. The one-year total return is a massive 37.25%.
That's huge.
It is, especially considering the S&P 500 hovered around a 12.5% gain over that exact same window.
Nearly tripling the broader market's return in a single year is incredibly impressive. But, 1 year is a short window in investing.
True, you can get lucky for a year.
Right. But the strategy actually holds up over the longer term as well. The 3-year annualized return is 31.49%.
Wow.
And the 5-year annualized return sits at 19.14%.
Okay, compounding at 19% a year over 5 years changes lives. But sometimes percentages can feel a bit abstract.
Yeah, Let's ground it in some real numbers.
Okay, let's look at the dollar cost averaging simulation from the sources. If you steadily invested $500 on the first trading day of every single month, starting in April 2023 and going straight through to May 2026.
Okay, so that's 3 years.
Right, 38 months total, you would have put a total of $19,000 out of pocket into the market. If you deployed that money into a standard passive S&P 500 ETF like SPY, your $19,000 would have grown to $27,030.
Which is a 42.3% gain on your invested capital. Not bad at all.
Not bad. But if you had deployed that exact same $500 a month into the GARP ETF instead, your $19,000 would have grown to $31,503.
That is a 65.8% gain.
Yeah. That is an extra $4,473 in pure profit on a relatively modest monthly investment over just 3 years.
It's a very tangible difference in wealth for the average investor.
It really is. But I have to pump the brakes here for a second. An advantage of over $4,000 on a $19,000 principal means we must be taking on more risk, right? There's no free lunch.
You're absolutely right. There is a catch. The Koala Gains risk analysis shows an elevated beta for core ARP, ranging from 1.20 to 1.33, with a standard deviation of 18.2%.
Okay, break that beta down for us.
Sure. A beta of 1.33 means the fund amplifies whatever the broader market is doing. By definition, the S&P 500 has a beta of exactly 1.
Okay.
So if the S&P 500 drops 10%, you can expect JARP to drop roughly 13.3%. It is essentially 20 to 33% more volatile than the broader market.
So when the market surges, you soar much higher, but when it tanks, you fall harder.
Exactly.
So we are strapping ourselves to a much faster rocket, which is incredible on the way up, but, terrifying on the way down.
But wait, remember the quality screen, the low debt, the stable earnings?
That algorithm filters for that?
That should theoretically offer fundamental strength to protect us when things get ugly. And we can actually measure this by looking at the downside capture ratio.
What does that look like?
Over a 5-year period, JARP's downside capture ratio is 112. It captures 112% of the market's losses, meaning it still loses more than the S&P 500.
Okay, in a vacuum, that sounds pretty alarming.
It does. But you have to compare it to its direct peers. The large growth category average has a downside capture of 127.
Oh, wow. So compared to pure growth, it's way safer.
Right. While JARP is more volatile than the broad market, it is significantly less painful to hold during a crash than its pure growth rivals.
And we saw that recently, right? The 2022 market crash was a perfect stress test for this.
It really was. The tech sector got absolutely hammered as interest rates spiked. During that period, the large growth category as a whole suffered a maximum drawdown of negative 32.4%.
But because of the quality and valuation filters, GARP's fall was cushioned at a negative 28.6% drawdown.
Exactly. It absorbed almost 4 full percentage points of the shock compared to its category peers.
So to summarize this for you listening, you accept more volatility than a basic S&P 500 fund, but because of that quality screen, you have a vastly superior shock absorber compared to the other high-growth funds out there.
You get the speed of the sports car without entirely sacrificing the crash test rating.
Perfect. I mean, JARP offers a highly structured, emotionless way to capture the massive upside of growth stocks while actively limiting your concentration in any one heavily hyped tech giant.
It cleans out the losers, trims the overpriced winners, and rebalances the portfolio every 3 months like clockwork, entirely based on fundamental data.
And it does all of that heavy lifting for just 15 basis points, which honestly leaves me with a pretty provocative thought.
What's that?
Well, if a passive mathematical index can dynamically rebalance itself, navigate market crashes better than its peers, and heavily outperform the broader market while charging a fraction of what human fund managers charge, what does the future hold for human stock pickers?
That is the million-dollar question.
Right. If an algorithm can simulate active risk management this perfectly, it raises a serious question about whether traditional, expensive, active mutual funds will even exist in a decade. Why pay a manager a 1% fee to guess when the math executes it flawlessly for $15?
The structural shift toward rules-based factor investing poses an existential threat to the traditional financial industry. The mathematical models are relentlessly efficient, and they never let emotion override the data.
It's just incredible. Well, thank you for joining us on this deep dive. Take a look at your own portfolio this week. Check your balance between growth and value, and ask yourself if you're overpaying for a sports car, falling asleep at the wheel of a minivan, or if you've managed to find that perfect hybrid.
Great advice.
Until next time, keep exploring and drive safe out there.